Welcome to the May edition of the Freight Loop by Drewry. I'm Simon Heaney, Drewry's Senior Manager of Container Research and the editor of our flagship Container Forecaster report. In the past 3 weeks, Drewry's World Container Index, a benchmark of spot freight rates on 8 east-west container trades, surged 49% with strong gains seen on the sub-indices of Asia to Europe Med and Asia to North America. It's fair to say this development came out of the blue, surprising consultants such as ourselves and ocean carriers alike. In this briefing, I will try to explain why this surge has occurred and give our views on its sustainability. Now, up until May, we were reasonably confident in our assessment of the market. A 3-month-long decline in spot rates, following the initial spike in January after the Red Sea diversions were first announced, seemed to back up our view that the market had sufficient capacity to cope with the prevailing demand, especially with the tidal wave of new build capacity arriving. As such, we were of the view that spot rates would continue on their slow downward trajectory until at least the third quarter peak season. However, events have clearly overtaken us, and that prediction was plain wrong. It's an occupational hazard for all forecasters, but it's important to understand how and why we got things wrong. For this, we have looked at 4 factors: supply, demand, the behavior of shippers, and operational disruption. Let's look at these in order. On the supply side, there seems to be an impression that shipping capacity is very tight. Now, this doesn't chime with Drewry research, which shows that effective capacity for the Trans-Pacific and Asia-Europe trades in April 2024 was broadly in line with the same month last year. Eastbound Asia to West Coast North America was up 4% year on year, but Asia East Coast North America was down 6%, possibly more to do with restrictions at the Panama Canal than anything else. Asia to North Europe was flat, while Asia to Med capacity was 11% higher year on year. But of course, we can't really know how tight any market is until we have seen the demand numbers and can match them with the capacity data. Now, unfortunately, demand data is always lagging, and the latest available series only goes as far as March. This means there is an information black hole, and in the data vacuum lies an opportunity for misinformation to be spread about a return to pandemic market conditions. The available demand data for 1Q24 does, however, confirm that loaded volumes are ahead of projections. The Trans-Pacific is the hottest market right now, with Asia to West Coast North America shipments up 23% year on year in the first quarter, while from Asia to East Coast North America the increase was 20%. Not quite so impressive, but growing nonetheless. Asia to North Europe increased 10%, with Asia to Med up 5% year on year. It's important to remember that these figures are coming from low bases in 1Q23 and are not quarterly records. For these trades, the 1Q24 volumes are down by at least 10% on peak quarters. The point being that the market has handled this level of volume before. We're not in uncharted demand territory here, or at least we weren't through the first quarter. There is no confirmed data as of yet showing that demand was significantly stronger in April or May than last year, but Drewry does have anecdotal information indicating that some shippers are bringing forward bookings as a precautionary measure, which brings us to the third factor: shipper behavior. Based on a survey of Drewry shipper clients conducted last week, the majority of cargo owners told us that they are not seeing increased demand volumes. For both the head-haul Trans-Pacific and Asia to Europe markets, the broad split was 60% reporting no increase and 40% saying that demand has indeed grown. While the shippers reporting stronger demand are in the minority, their percentage is sufficiently high to suggest that the markets overall are growing quite fast. The full results of the survey are available to members of Drewry's Shippers Benchmarking Club, but I can summarise some of the other findings here. Most of the shipper respondents said that inventory levels were currently at target level. 79% for North America, and 73% in Europe. So we can probably rule out abnormal inventory restocking as a cause for the demand surge. What about shippers bringing shipments forwards, possibly mindful of the longer lead times due to the Red Sea diversions or out of fear for future disruption in some form or other? The survey results suggest that is definitely a contributing factor, but not to a large extent. Only 19% of respondents to the question for the eastbound Trans-Pacific said they were shipping early, while 26% said the same for the Asia to Europe market. As mentioned earlier, effective capacity has broadly been maintained at pre-Red Sea crisis levels. However, service schedules have been extremely inconsistent with a large number of blank voyages, mainly because carriers have not been able to find suitable tonnage in the charter market to plug the weekly gaps. Longer round voyages, broken schedules and bad weather have all seen congestion in Asia ports worsen in recent weeks. This, in combination with the sudden demand surge, has created shortages of equipment, which has triggered the spike in spot rates. Until just a few weeks ago, the market wasn't so tight and was coping relatively well, but it would seem that heightened operational disruption, along with the swell of demand, has proven to be the tipping point. In our view, some of these pressure points should ease off soon. Firstly, as more new build capacity arrives, the blank gaps in schedules should be filled. After 4 months of this year, around 1 million TEU of new ship capacity has been delivered, much of which was absorbed by the Suez Canal diversions, but another 2 million TEU will arrive before the year is out. This will help improve the flow of containers back to Asia, while weather conditions won't always be so bad. Lead times are expected to remain elongated, as we share Maersk's view that the Suez Canal will not return to full-scale use before the end of this year. Now, if demand continues to perform above expectation, the pressure on liner networks and container availability could remain high. Taking into account these caveats, we forecast that the current spot rate rally on the Asia-Europe route will start to reverse in June, and that the Trans-Pacific market will stabilise or soften in the second half of 2024 as record additional capacity is delivered. Thank you for listening, and we hope you will join us for the next edition of the Freight Loop in June.